Hey everybody, it's Daniel here from InfoRes. Hope you're all doing well. Sorry I couldn't make a video past couple of, actually last week. I've been a little bit under the weather, sick, but better now. I'm still recovering, but I'd say 98% better. Anyways, let's talk about what's been going on in the markets, what to expect this week. This week is actually going to be the biggest week for the month in terms of data on what's coming out. Right, we've got consumer price index that's literally coming out tomorrow. We got the FOMC coming out Wednesday. So those are the crucial data points that we want to track, especially for this week and going forward, and especially the FOMC to have an idea where their head is in terms of rate hikes and rate cuts and pause and etc. Right? So I'll talk about that shortly soon. But first things first, you know, we've been seeing quite the rally in gold and in Bitcoin last week, right? We saw Bitcoin really push up above that $40,000 mark. We saw gold also have a nice spike during the futures Sunday open, and that spike I would say that spike comes from basically shorts getting squeezed because we had a nice pullback in gold. And mainly, you've been seeing gold and Bitcoin pick up a bid all because we're seeing the US dollar come down. So you're getting this repricing of rates, right? Repricing that, we're going to see rate cuts eventually soon. We're gonna see rate cuts happen sooner than later, and that's being repriced in. Now we did get jobs data last week, and the non-farm payrolls number that weren't bad at all. So it showed some strength there. We had a reaction in the bond market and stock market. The initial reaction was you did see those sell-offs coming very quickly. But then the stock market completely reversed course, and the bond market rallied a bit, but then afterwards pulled back. So, on what are we seeing now, right? After all of this last week, well, we're basically waiting for the FOMC, and most importantly, before that, we're waiting for CPI, right? Because this whole rate hike narrative has come from, or especially from the Fed. Um, Higher for longer narrative comes from basically inflation sticking around. So now, if we get weak inflation tomorrow, right, you're going to get the bond market and the stock market, reacting to that quite a bit. You're going to get also the repricing in the bond market as well. You did see basically in bonds the yields come down, creep up actually, after coming down quite a bit, and that comes from after the better than expected jobs report, non-farm payrolls report on Friday, right? So what's going to be interesting is tomorrow, if the number comes in really weak, are you going to get the bond market to now pick up a bid and those yields to come back down, right? And so the bond market here, what it's doing is why it's shifting up and down in those yields is because it's trying to figure out it's not pricing in any more rate hikes. Okay, so rate hikes are basically as of right now, unless anything changes, right? As of right now, it's out of the question. There's no rate hikes coming, right? We're in pause mode. We've been in pause mode for some time, right? Pause mode typically lasts somewhere between 6 months to 12 months, right? And then you start to get the rate cuts, right? So what's happening is the bond market, the reason why you're getting the yields to go up and down and basically trade in this range is because the bond market is trying to figure out and pricing, okay, when is the cut coming, right? Some say that, oh, the cut's going to come in the first quarter of next year. Some are saying that, okay, no, it's actually going to be June, July. And actually, the bond market was pricing in before that July we're going to start to see rate cuts. That shifted now to May, right? And now with the new jobs report, it's again shifting again. So we're going to get inflation numbers, CPI. That's pricing, the bond markets are going to price it again differently. And then it's going to come the FOMC meeting, right? The minutes, we're going to hear from Chairman Powell. We're going to hear what he has to say. Very likely Powell's going to come out and still push the higher for longer narrative. We still need to assess. We still need to look at the situation with inflation. We're not done 100%, right? And then you're going to get the stock market reacting accordingly. I think they're going to call, the bluff on Powell unless he comes out really, really hawkish, right? But not expecting that at all. And then you're going to get the bond market also to price in accordingly, okay, where they think maybe the rate cuts are going to come. And then that's it. Then after this week, it's probably going to be, I mean, you have other data points as well, but it's going to start to slow down, be dead, and then we get into January. And then January, that's when we want to see again those jobs data, the inflation numbers, and then repricing again, and the next FOMC meeting, right? Now, what's going to be interesting also to note that does Powell say anything in terms of acknowledging more of the pause? Does he shift towards more on the dovish side of things? That's the question. He's going to see things change up a bit, and do you start to hear him really lower the tone and be more dovish than expected? If that's the case, you can expect those yields to really plunge. You can expect bonds to go up, gold to go up, Bitcoin to rally, US dollar to come down, stocks to also rally quite aggressively, right? If he comes out more on the dovish side. But I think how I'm looking at it is Powell's probably going to be more balanced. There's not going to be a rate hike this week for sure. Going to reiterate the stance of higher for longer. We assess the situation. We need to see a couple of months of inflation data, then decide what to do. We haven't talked about, and he's going to say, we haven't talked about, rate cuts yet, etc., etc., right? So that's what is expected. And we'll see how the markets react according to that. But before the FOMC minutes, you got CPI, and that's very crucial because as soon as the CPI number comes out, you're going to get the bond market and stock market to kind of predict and price in things before the FOMC meeting on Wednesday, right? So they're going to try to judge, okay, because of CPI came in weak again, we think rate cuts sooner than later, then equities and bonds and gold and Bitcoin all rallying, right? And you have that also connection with the US dollar. So as long as you see that US dollar continue to show weakness, that should also propel gold and Bitcoin as well. Now, here's one wrench I'm going to throw on the gold narrative and also on the Bitcoin narrative, although there's a lot of reasons to be bullish, especially on Bitcoin. But let me just throw one wrench there and play devil's advocate, is that we haven't got rate cuts yet, right? So we haven't got rate cuts yet, and that may not propel gold just yet, although you can get people front running and whatnot. But if that happens, you could be prone, if anyone's going long, especially close to the triple top, quadruple top there, you could be prone to more shakeouts easily in gold. And then people, really selling and getting out of their gold position, trying to, front run or get too early on that trade. However, if rate cuts start to be the topic and then you do get some rate cuts, there could be a little bit of a run in gold. But then again, right, why to have rate cuts so early? That's the question. And if you're going to have rate cuts very early on, especially if inflation hasn't hit the 2% target, right? And if that's the case, then I think that initial rally in gold on optimism of rate cuts and easing whatnot will be short-lived, and then you'll get a pullback if there is some sort of hard landing, crash, panic. Because what happens during that time, almost every asset class completely goes into panic mode, and you see that real strong selling, right? So that's what I think. And again, it has to be that you're cutting rates because of hard landing, because of some sort of credit event, which may propel gold initially, pull back, and then the move back up higher. But although rate cuts, QE, easing, whatnot should be positive for gold, for Bitcoin longer run, and bringing the dollar lower, also propelling those two asset classes higher. The other thing I'm going to leave with you as well is everyone forgets about what Powell said about 3 years back, 4 years back, right? So 4 years back, they talked about the AIT, which is the average inflation target. Give me 1 second, I'm just going to pause this. Okay, so AIT, average inflation target, right? So the average inflation target was mentioned, during the COVID time, saying that, and I think it was a little bit before that too. I don't remember exactly. It was 2019 or 2020. But average inflation target AIT was introduced to the market, saying that, hey, we want the average inflation level to be above 2% or at 2% or below or whatever, right? We want the average amount to be around the 2% level. And what that does is why is that important? Is because it takes the average longer for it to go up, right? To go to the 2% target, right? So that means that you would allow, looking at the inflation print, inflation to be above 2% couple of times, right? Now that would mean that inflation could come in 2.5, 2.3, 2.2, the 1.6, 1.5, 1.4, and then you're adding all this to get the average at 2%. So you're allowing hot inflation metrics and adding it into the average, right? So not many people talk about that. So I don't see them change or talk about AIT that much anymore, but since they said they're following it, and I haven't heard anything that they said that they stopped following it, so in that case that they are following the AIT, which means that if that's the case and they still are, then in order to get rate cuts, even if inflation comes below, right, 2%, they may sit and do nothing, right? Even though the markets are expecting that they're going to get rate cuts soon, they may do nothing because they want the average number to come down. So that means that the number needs to go below 2% for multiple reports to then get the average down to 2%, right? And what will that take? Maybe it may take a credit event, right? That crash that I keep mentioning about, the hard landing, in order to get the AIT to that 2%, and then decide, okay, time to cut rates, right? So don't think that, okay, we're gonna get rate cuts all of a sudden just because the bond market's pricing and just because someone's telling you rate cuts are coming. There's gotta be a reason. There's gotta be a reason, and they're not just gonna do it all of a sudden, especially because they're following the AIT, average inflation target. So the markets could be totally off about rate cuts coming in May and June, July, or even first quarter. It could come at the end of next year or start of 2025 because, again, AIT, average inflation target, and waiting till you get that crunch in the demand to really bring that average down, right? So anyways, couple of pointers there, and let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified of the next video, and I'll see you guys around. Cheers, bye.